Well, hello there, interweb nuts. Have you checked your web nuts today? That the expected has happened. Yes, the expected has happened. Headline news, breaking news, everybody. This just in. The expected has happened. All right, what do I mean? Well, very often in the world of marketing, be it information or products or services, you will find that people get juiced and excited. People get juiced and excited about the very, very obvious things that have happened. And then they do their best to bring attention to those things as if they're news, when they're just stating a record of things people knew would happen if they simply knew how to read facts correctly. And then, bringing it to the attention of those who didn't know for whatever reason, right? Because they're just not aware of that. Or if they are aware of it, they just don't know how to read it correctly. So to them it's a surprise, because they didn't know how it would be. Can I give you an example? Yes, I can give you an example. Many, in fact. If you report on things like, we can start simple, right? A plane has landed. Well, at the scheduled time, in the scheduled place. Okay, that's not exactly headline news. In most cases, right? Unless it's something very special on that plane, or it's arriving at a very special time in a very special place, doing some kind of very special action, right? Or, if the price of milk is whatever, $4 a gallon. Milk is $4 a gallon. Okay, that's the expected. It's not news. All right. We see plenty of that. See, 2 days ago, when the price of Bitcoin, for example, pumped a little, what did people say in the ecosystem? Right, they were frankly doing the usual, getting all excited about something that was, to be perfectly honest, very predictable and predicted. Who predicted it? Well, I sure did, and other people did too. How? Well, we know how to read the VEPs. What does that mean? Well, for one thing, if you're looking at the daily time frame, you would have seen that last week there was an outlier on the third standard deviation band to the side of the 3012 RMLR. What does that mean? That means that the price action of Bitcoin had followed the returns down to where it had passed a third standard deviation band to the downside of the RMLR. Now, it doesn't matter if it's up or down, as I've told you many times on this channel. When you have an outlier in one direction or another, up or down, after the asset stops smashing that band, after it comes back within, once it comes back within that third standard deviation band and passes at least 2 candles, usually 2 is where it's confirmed, but 2 candles, well, at that point, unless it already does it on the 0, 1, or 2 candle, but once it passes 2 candles, if it hasn't yet mean reverted to that RMLR, 3 standard deviations away, then there is an extremely high probability that it will, in fact, complete that mean reversion to that RMLR before it hits that third band again. Why is that? Well, because math, right? Literally because math. There's no other reason that happens. It's just math. Now, could it be, and has it ever happened, that there is an outlier to one side or the other, all the way to the third standard deviation band, up or down, of the RMLR, and it hits for 1 or 2 or 3 or 4 candles, keeps hitting it, and then a couple candles pass, maybe even 3, 4, 5 candles pass, and you think you're in mean reversion, and it suddenly goes back and hits that third standard deviation band, that same third standard deviation band again before it reverts to that RMLR. Yeah, it could be. It even does happen. How often does it happen? Extremely rarely. What do I mean by extremely rarely? Well, less than 0.3% of the time. In fact, far less than that, but less than 0.3% of the time. Which means, if you have probabilities indicating 99.7% or more of the time, not only is the asset likely to close within that 99.7 percentile, but once it does, and it has closed 2 candles within it, then there's an extremely high probability, just about as high, if not higher, than the 99.7 percentile, that will in fact close the mean reversion all the way to that RMLR. And the reason that happens is because the returns mean revert. And I've been telling you this as we have been on our group over at Alpha Trading, that returns mean revert. Price action follows the returns. Right? The volatility, which is the standard deviation of log returns of investment, or standard deviation of returns for short. Volatility is that standard deviation of returns. Variance is the spread of data around the mean. That's another way of saying variance is volatility. Because what is the spread of data around the mean in tradable market assets? Well, the spread of data is the bid and ask, right? It's the buy and sell points spread. And it's the delta between the buying and the selling. And it's constantly changing. People are saying, I'll buy for this. And some people are saying, I'll sell for this. So, that is why we can see that volatility creates the price action. Because volatility creates the returns. Because volatility is the standard deviation of the returns. Right? So the returns are the active component. The standard deviation of them is the volatility that makes the activity cause the price action to follow the returns. It's really all just a very logical flow. But you can say to me, well, how do you know the standard deviation of returns before you know the returns? You know them at the same time. You find them out depending on which one you look up first. Because at the same time that you have the returns, you also have the standard deviation of returns. And it's that volatility that causes that price action, not the other way around. Right? And I understand it's complicated for people to think, because the average person will say, well, I don't think about volatility when I buy something. I just see a price and I offer my price, and if they take it, they take it. If they don't take it, they don't take it. And that's price action. No, that's not. That's literally, you're creating volatility when you do that, right? And if you say, well, I don't even do that. I just go and I see prices and I either buy or sell. If I want to buy or sell, I don't ask for the price. Right. You don't. But if you're buying something, the seller is asking you for a price. If you accept the price, then you're accepting their price. So you are the counterparty to their trade, which means you've just created volatility. If you are, selling something, and you have a price set on it, and the person coming to you doesn't change the offer, says, okay, I'll accept your offer. They're a market taker. They're not providing liquidity to the market, they're taking liquidity from the market. They're saying, sure, I'll take with a market order. Right? So they're not changing the price that you're offering. They're accepting it, but they're still affecting the volatility. Well, how is it affecting the volatility if there's no difference between the buyer and seller? Well, because sometimes the difference is 0, and sometimes the difference is a half, and sometimes the difference is 1, and sometimes the difference is more. Right? So there's always going to be a balancing act between the buying and the selling. That is the nature of how volatility is created. It's the buyers and sellers who have the prices they want to sell or buy for, and by coming to a happy medium, agreeing on a buy and sell price, they have balanced in that moment and created the price action at wherever that is. And in so doing, they've confirmed yet again with every single transaction that the price action is following the returns. Well, how are the returns being determined before the price action? Well, because the returns are what the smart money are looking at. Why do investors invest money? For the returns. That's how much you're getting over a period of time. Right? Positive or negative. Preferably it'll be positive if you want returns and have more profit. Right? If you want to lose, then you're looking for negative returns. And believe it or not, there are, for a variety of reasons, people who do that. Of course, most people are not looking to lose, yet most people do lose, and yet they continue to participate in the thing that makes them lose. Why is that? Masochism. Pure and simple. They think they cannot win a market, so they try, they fail, they try again, they fail again. They try as many times as they try. They continue to fail. And all that failure adds up to they're masochists. Because if they weren't, they would do something else. Because they should realize after the 10th or 50th or 100th or 1000th failure that repeating the same mistake in the hope of being right the next time is folly. Right? So on that note, a happy positive note, always remember to change things up. Enjoy your life. Do the most you can. Do the best you can every day. Be the best you can. Be good. All right, happy trading. Take care.